So we are now looking at an accounting equation, but looking at it from assets equals to owner's equity plus liability. Okay, here we are looking at an equation in totality. So you have your asset, you have your owner's equity, then you have your liabilities. Okay, what do we mean by an accounting equation? We mean that your assets are equal to your owner's equity plus liabilities. For example, when a company or our entity apply for a loan or for finance, this particular company, when they receive an amount of loan, it will be two accounts will be affected. It will be your loan account and your bank account. With your bank account, you are looking at your assets increasing, and your assets, they increase on the debit side. So that means we are now having more money in our bank account simply because of an amount being borrowed. And with our liabilities, we are looking at the external entities that we have borrowed money from. So loan account will also be affected in your liabilities. So it will be an increase because we are now owing more than what we were owing previously, or we are now owing more people or more entities or more financial providers than what we were than the number of financial providers that we were owing previously. So here, with regards to this example, we are looking at an asset having a plus, owner's equity not affected, then a plus again of plus from your liabilities. That means if you have borrowed an amount of money of 5,000 rand, it will going to be plus, and plus 0 is nothing, then is equal to 5,000. So positive 5,000 is equal to positive 5,000. That's exactly what we mean when we are referring to an accounting equation. Your assets are equal to your owner's equity plus liabilities. On this slide, we are looking at an example where we are now paying for this amount of loan. So if we are paying an amount of loan, that particular entry will give a negative effect towards your assets, simply because you are taking money from your bank account to pay off for your loan. So if you are paying off for your loan, it means that your asset will decrease, but again your loan balance will also decrease, simply because you are now owing less due to the payment that you have made. Journal entry for that will be you debit your loan account and you credit your bank account. So asset is equal to owner's equity plus liability. How? It's easy. Here, let's assume that you paid 5,000 rand for loan. Your loan balance or your loan amount or your amount owing will be reduced by 5,000 rand. This 5,000 rand also, again here, it was taken from your bank account. So your bank account is being reduced, yet again your loan balance is being reduced. So that's what we mean by assets equal to owner's equity plus liability. With these examples, I'm trying to explain the relationship between an asset and a liability, and the relationship between owner's equity plus liability. So in this case, again, owner's equity is not affected. So minus 5,000 is equal to minus 5,000. Your asset is equal to owner's equity plus 5,000. Your assets are equal to owner's equity plus your liabilities. Then on this slide, let us look at again a relationship between, or a positive relationship between your assets and your liabilities. So let us continue. Here we are looking at a positive relationship between your assets and your liabilities. So here we are looking at two accounts being affected, which is trading stock and creditors control. Okay, now here we bought goods on credit, meaning that bank is not affected, therefore cash is not affected. But by us buying trading stock on credit, it means that the first account that will be affected is trading stock under assets, simply because we are now having more trading stock than what we had previously. And again, on this particular owner's equity account, it's not affected because two accounts are affected. It's trading stock, which belongs to assets, and creditors control, external lenders or companies or entities or wholesalers that are willing to sell goods to us on credit. So here also the amount owing is being reduced, or the amount or the number of external lenders or wholesalers that keep on selling goods to us on credit, they are also increasing. So assuming that the trading stock was bought for 5,000 rand on credit, is going to be plus a certain amount, let's say for example purposes 1,000 rand. You're going to debit trading stock 1,000 rand and creditors control 1,000 rand. Both of these accounts are increasing, but the other account is debited, which is trading stock under assets, and another account is credited, which is under liabilities. But both of these accounts are increasing, and owner's equity is not affected. So if trading stock were bought for 1,000 rand, then that means we are owing these people 1,000 rand, or these companies or entities 1,000 rand. So your assets is positive 1,000 rand equals to positive 1,000 rand. Your accounting equation is balanced, or it's balancing. Okay, here we are also looking at a relationship between assets and liabilities. We are using these examples so that we are able to explain thoroughly this accounting equation and how it's being applied, and rather the meaning behind this accounting equation. On this example, we are looking at a situation where these two accounts under assets and liabilities directly having a directly negative. We are looking at these two accounts which are bank and creditors control, but both of these accounts are decreasing, meaning that they affect the bank is affecting assets negatively, and liabilities affecting, and creditors control affecting liabilities negatively. Why? Simply because in this example, we are looking at a situation where we have paid our creditors. We no longer owe them, or we owe them less due to a payment being made. So if we are referring to a payment being made, now your assets are affected, but they are affected negatively. They are being reduced simply because there was a payment made to creditors. So in this case, this particular payment will result in an outflow of cash, or a decrease in economic benefits, or a decrease in assets. So what you need to do here, you need to record a journal entry. The journal entry will be debit creditors control and debit in credit bank. How? Because your bank is an asset account, it increases on the debit side and decreases on the credit side. So in this case, your bank account is decreasing, your bank account is being reduced. And again here, owner's equities are not affected in such a way that there is no entry here. It's nothing under owner's equity. But the creditors controlled under liabilities, they are affected because we are now owing less companies. We are now owing a less, or we are now owing a reduced balance due to a payment that was made. Now let us look at relationship between owner's equity plus liability, or owner's equity versus liabilities. In this example, we are looking at an account called stationery. An account called stationery, whenever we buy stationery during the financial period, we buy the stationery and record it as an expense. We record it as an expense. But at the end of the financial year, once we determine stationery or consumable stores on hand, that particular consumable stores on hand becomes an asset. Then the stationery that was bought during the year and was used or utilized or consumed, that particular stationery also remain an expense, or will remain an expense. So in this case, we are looking at owner's equity versus liabilities. So for this accounting equation to be in balance, it means that these two should give us 0 because asset is not affected. How? Let me explain how this works. Let me explain how this is going to be done. For example, we bought stationery on credit. Two accounts affected, stationery and creditors control. So with your stationery, we are referring to an expense account. So your expense account will be debited. But remember, with owner's equity, we are not only looking at how is this account affected, whether this account is increasing or decreasing. And if stationery is an expense, it means it will increase on the debit side. But stationery is an expense. More expenses you incur, less profit you are going to make. That is why we are having a negative sign or a minus there, because we bought stationery on credit and this stationery is treated as an expense. So the more expense you incur, less profit you make. That is why it's negative. But by us buying stationery, your expenses are increasing. But the effect of this increase of stationery with regard to owner's equity, it reduces your profit. That is why it's on the negative. Then let us look at your creditors control. With regards to your creditors control, we are referring to external lenders or wholesalers who are willing to sell goods to us on credit, or who are willing to sell trading stock or raw material, or whatever the case may be, on credit. So creditors control is being increased because we are now having higher creditors control balance simply because we continued to buy on credit. Therefore, the two, let us say we bought stationery for 5,000 rand, is going to be minus 5,000 rand plus 5,000 rand at creditors control, of which it will give us a 0. So asset is equal to owner's equity plus liability. So a 0 is equal to 0 plus 0. In this case, these two, your owner's equity and liability, should always give you a 0 if both are affected and asset is not affected. So that 0 will be equal to 0 and your accounting equation is in balance.